Wall Street, I'm Charlie Pellet with today's company headlines. Goldman Sachs may eliminate as many as 4,000 employees as CEO David Solomon battles to contain a slump in profit and revenue. Goldman Sachs shares today, they are trading lower along with the rest of the market. We've got Goldman down now by just about 1.5%. Sources say top managers have been asked to identify potential cost reduction targets. No final job cut number has been determined. Headcount at the Wall Street giant has surged in recent years as Solomon completed acquisitions to build a more diversified company. Again, Goldman Sachs shares down now by 1.5%. Sources tell Bloomberg Boeing is closing in on an order for as many as 200 of its 737 MAX jets from Air India's new owner, Tata Group, as the two sides race to wrap up talks before the year-end holidays. Boeing shares down by 0.4%. Asset management giant BlackRock is cutting costs across 8 of its exchange-traded funds as the industry's endless fee war continues. And 2022 will not end fast enough for Verizon. By the time the books close, the largest American wireless carrier will have logged a third straight year of below-industry growth, going from first to last in mobile subscriber gains. Verizon shares down 2% now, T-Mobile up 1.1%, AT&T down by 0.7%. Those are the company stories we're following at this hour. I'm Charlie Pellet. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Madison Mills in for Carol Massar this afternoon. Let's get to world and national news. For that, we turn to Nancy Lyons in our 99.1 studio in Washington, D.C. Hey, Nance.
Thanks, Tim. Ukraine is calling today's Russian missile attacks the worst so far since the invasion began. Russia launched over 60 missiles, causing cuts to power and water supplies in several areas. The attacks come a day after a top Ukrainian army commander warned there's no doubt that Russian forces will attempt to seize Kyiv as soon as January, after failing to do so last spring. Well, the U.S. is doing what it can to rush weapons to Ukraine. We get more on that from Bloomberg government reporter Emily Wilkins.
The Pentagon is finding ways to sort of do some shortcuts to standard contracting procedures just to make sure that the U.S. weapon supply still remains strong, even as they continue to supply Ukraine with the more weapons they need.
Bloomberg government's Emily Wilkins in Washington. President Biden is spreading the word to U.S. military veterans about his administration's efforts to improve their medical care. Bloomberg's Irv Chapman has more on Biden's trip today to Newcastle, Delaware.
The president urged them to seek the care and benefits Congress recently authorized for those exposed to the huge pits where toxic materials were burned during the Iraq and Afghanistan wars.
It's one of the most significant laws in our history to help millions of veterans who are exposed to toxic substances during the military service. I'm urging all veterans of these decades of war to get screened for toxic exposure and to promptly file your claim.
The president lauded those who were deployed again and again in the recent wars, as well as a 102-year-old Air Force veteran of World War II who came to hear him. In Washington, Irv Chapman, Bloomberg Radio.
Brittany Griner says it feels so good to be home and describes the last 10 months in Russia as a battle at every turn. In an Instagram post, Griner says the love from so many kept her going, and as a thank you, she plans to return to the Phoenix Mercury and play this season. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to you, Maddie and Tim.
Thank you so much for that update, Nancy Lyons. Really do appreciate it. Well, in just a few minutes, we're going to be joined by our friends at Bloomberg TV for our countdown to the close. In the meantime, Madison, I wanted to talk a little bit about some of the top read stories on the Bloomberg terminal. We talked yesterday with our own Alex Branca out in Los Angeles, who covers social media, about what's going on with TikTok. Nancy Pelosi, House Speaker Nancy Pelosi, threw her support behind banning TikTok on government phones as part of a must-pass government spending bill coming to a House vote next week. I asked Alex yesterday, Madison, about why any government official would want TikTok on their phones, and she was like, I actually have a perfect answer for you, and she told me about the Utah Department of Transportation, and it made me think, you are right. I've seen the New York City Department of Sanitation TikToks. It's not the federal government. It's not quite, a White House intern with TikTok, but I'm wondering about the latest from DC when it comes to
Yeah.
how they're thinking about TikTok.
I mean, it's a great way to reach constituents where they
She
are,
also said
right?
that, yeah.
It's an incredible way to like build local issues up with your voters, and it's really interesting because I've been in DC these past couple weeks for a big BN project to launch in the new year. But as part of that project, I interviewed Senator Mark Warner. He is the chair of the Senate Intelligence Committee, and I said to him, "What are you going to say to your constituents under the age of 30 when you are pushing for TikTok to get banned in the U.S.?" And he told me, he was like, "I'm going to tell them that their photos will get hacked and that the Chinese government is, looking in their camera rolls and gonna leak some pics that they don't want leaked if they're worried about it." But I mean, you know this, Tim. I have an addiction to TikTok. I just sent you a TikTok in the last commercial break. So I would be very personally victimized by this legislation.
You would, but maybe, you would get back on Instagram where, all the
God.
elder
Do I have
geriatric
to?
millennials are going to watch the TikTok 6 weeks after they're on TikTok. More coverage of this and more coming up in a few minutes. In the meantime, a check on what's going on in the trading day. We are getting to our friends at Bloomberg TV. This is Bloomberg.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left in the trading day and in the week. Romaine Bostic here alongside Katie Greifeld. We're joined by our colleagues Tim Stinovic, Madison Mills in today for Carol Master. We welcome our audiences across Bloomberg Television, radio, Quick Take, as well as on YouTube. A day that's now shaping up to be the third day of losses here for equities here, solidifying, Tim, what's going to be a second straight week of declines.
Yeah, a lot of superlatives out there, Romaine. We're already seeing over the past week down more than 2% on the S&P 500. I'm looking at stocks in the S&P 500 and on U.S. exchanges that are hitting 52-week lows today. We got more than 315 stocks on U.S. exchanges hitting 52-week lows. In the S&P 500 itself, we got 18 stocks hitting 52-week lows, and perhaps you can guess 0 in the S&P 500 actually hitting a 52-week high.
And it's notable that on a day in which the broad market is extending its sell-off, we've got Netflix seeming to have found its floor now. We still don't know if its strategy to expand to ad-supported subscriptions is going to work, but maybe that skepticism is starting to get priced in for now. Even with today's recovery, we should know Netflix has had a whiplashy 2022. First half of the year, it was one of the worst performers. Now it's back to being the second best in the second half.
Well, we go, of course, to the broader look at the broader markets here on this day. 1% drops across the board here. Now, as we get basically about 6 months from the start of this bear market, of course, started back in the middle of June. Whatever optimism we had in August, whatever optimism we had in October and November, and whatever optimism we had on Monday and Tuesday, Katie, appears to have dissipated completely.
Not a lot of optimism, too, if you drill down to the sector level. 11 out of 11 sectors are in the red right now. It's real estate that's down at the bottom, down about 3.5%. You look at the top, the relative outperformer, you have communication services off by just 0.3%. A lot of that, though, is just Meta getting an upgrade from JP Morgan today, so that helps.
Yeah, well, I didn't want to be all gloom and doom today here. We take a look at some of the individual movers, and there are a couple of bright spots out there to keep an eye on, including Adobe, which came out with earnings and actually gave a forecast that I think did, to a certain extent, reinforce the idea that there are certain pockets of business spending, of software spending, of subscription spending that can hold up, even in a declining economy here. Meta Platforms up about 3% here on the day. Tesla, I don't know what's going on. Tesla right now at 151, down 4% here on the day. We talk about how Netflix, one of the best performing stocks in the second half. Tesla is certainly going to be one of the big stories, I think, when we look back on 2022.
Do you think this is as much about what's happening on Twitter as it is about what's happening at Tesla?
I think it's a combination of both. You have, of course, a declining market. You have more competition in the EV space. You have a lot of concerns about the presence they have in China and the COVID-0 policies there. And then, of course, you sort of tie the bow around it, which is, let's just say, a CEO who's been a little distracted by other things in his life right now.
And spending a lot of money, specifically in the form of selling Tesla shares. I think it's hard to disentangle the two at this point.
All right, well, let's disentangle here from our daily Elon Musk discussion. I do want to point out Darden Restaurants. I know you're a big fan of Olive Garden here, because this brings us back to the earnings.
Breadsticks.
Absolutely, but this brings us back really to the earnings story here, and the idea that a lot of folks think the earnings expectations need to come down. Here's the thing, they already have come down significantly, but right now the forecast going forward is still at around 230 here on the S&P for EPS just going forward. And based on a lot of estimates, people think that's still too high, that we need to be closer down to that 200 level. This includes a lot of big strategists on Wall Street, including Mike Wilson. And if that is the case, if that does come to fruition, it also means an additional re-rating of valuations out there in the equity market, and that could mean a lot more pain.
All right, well, speaking of more pain, the longer rates are high, the longer we're likely to experience some sort of pain. Federal Reserve Bank of New York President John Williams spoke to Bloomberg's Kathleen Hayes a little earlier today. He said that while inflation has showed some signs of slowing, there are some good reasons to keep interest rates high for some time. Check out what he had to say.
We have clear signs that demand exceeds supply in our economy and our labor market. So to me, the question of how high we have to get to is really going to depend on what we see in inflation and the supply and demand imbalance. We're going to have to do what's necessary, again, sufficiently restrictive to bring inflation down to 2%, and it could be higher than what we've written down.
Okay, it could be higher than what we've written down. That's certainly an important element of that. Here we had, of course, Federal Reserve Bank of New York President John Williams speaking to Kathleen Hayes a little earlier today, Maddie.
Well, for all the talk that we've got that inflation's peaked, the Fed's updated forecast shows it sees inflation higher than what they'd anticipated, 4.8% core versus September forecast of 4.5%, which of course matters as the Fed is watching inflation to determine the path of rate hikes as we head into the new year. Whether we're going to see that soft landing remains to be seen.
And it is going to be fun. Not a lot is happening next week, but we do get an update on PCE. I'm going to be watching it very closely because there's not much else to keep an eye on. But
wait, we still got earnings, Katie.
We still have earnings.
We still got earnings. We got Nike, we got FedEx, we got Micron.
Okay. Well, that being said, we do also get
I'm going to be on
PCE.
vacation.
You are going to be on vacation.
That's what really matters.
Going to be on vacation. I'm going to be here, though. I'm going to be watching PCE. And we think about what we got from Williams, what we got from Daly, what we might get from Loretta Mester. You still have 2-year yields down about 5 basis points today.
Yeah, a nice plug there for Mester. Mike McKee going to be coming up in just within the half hour here with an exclusive interview with the Cleveland Fed president. I do want to circle back, though, to the bear market that we are in, and to be sure, we are still here. This has, of course, not been the longest bear market ever, but there are a lot of concerns, I think, as you alluded to, Tim, that if rates stay higher for longer, then by default, that would mean, of course, that would put a lot of downward pressure on risk asset pricing as well as the economy itself, and maybe that does set us up for a much prolonged period of bear market conditions.
It feels like, Romaine, we've been playing this out, like kind of the same thing over and over again, really since Jackson Hole. Yeah. We see some sort of rally because investors...
Remember when Bill Murray basically said the only way to sort of right the world is to kill that groundhog?
I've never made it through
I don't know who the
movie.
groundhog is in this analogy, but he's got to go. He's got to go.
Maybe markets are the
But it's like
groundhog?
anytime investors latch onto some sort of good news that seems to be, the Fed is potentially going to pivot or inflation is coming down a little bit, Maddie, then there's some sort of other news, whether it's, Jay Powell coming out and essentially squashing that rally or, the other central banks saying, guys, we got a long way to go.
You guys are so gloom and doom. Maddie, do you have a favorite Christmas song?
Well, listen, Romaine, I mean, this is why I feel like the Fed's Christmas song this year should be, this is not going to be soft. This is going to be a very, very turbulent, messy, Sully in the Hudson landing. I mean,
that's not very catchy. You gotta come up with something else.
Yeah, I'm sorry. I'm feeling
sings that?
Halloween vibes. It's it's the witching day, right?
It is triple witching day.
Oh, I forgot about triple witching.
My favorite song.
I'm scared.
All I Want for Christmas Is You by My Chemical Romance.
Stop, Katie, don't say My Chemical Romance.
I love My Chemical Romance. In any case.
Okay, well, that's one way to go. Tim doesn't have a favorite, does he?
No, they're all
listen to music? You just probably listen to podcasts and stuff.
No, I listen to music.
Tim only listens to the Atlantic podcast.
The Atlantic, of course.
I listen to music, but I'm not proud enough of my choices to share my Spotify Wrapped for the year. That's going to stay between me and Spotify. Guys, that is going to do it for our cross-platform coverage, at least for now. I do want to encourage everybody to check out that interview with Loretta Mester a little bit later today. Mike McKee taking us into that in a little under a half hour. We're going to be back together live on TV, radio, YouTube, and Quick Take at 4 p.m. for our Beyond the Bell coverage, where we take you through today's market close.
This is Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Madison Mills in this afternoon for Carol Massar. Well, earlier this week, we spoke to Michelle Eisen, lead organizer of Starbucks Workers United and a Bloomberg 50 honoree, about her role in unionizing about 200 Starbucks stores across the U.S. Check it out.
So we're up over 7,000 new unionized Starbucks workers in just over a year. And I do expect it to continue because the momentum really hasn't slowed. What we've seen is increased interest from Starbucks workers to unionize their stores because, things are hard. Things are even harder now than they were, a few years ago to be a service worker, to be anyone of the working class. And the reality of the situation is that, the billionaires are not looking out for the working man. And so we need to join together and raise our voices and fight for what we believe is fair in our workplaces.
That was Michelle Eisen, lead organizer of Starbucks Workers United. For more of that interview, check it out on our podcast feed. You can do that at Bloomberg.com. And again, Eisen, one of the Bloomberg 50 honorees this year. Check out that at Bloomberg.com. Well, Starbucks baristas at 50 locations throughout the U.S. are starting a 3-day strike today, saying the company is not bargaining fairly with unionizing stores. It's the biggest strike ever put on by Starbucks Workers United. It's the labor group for about 270 of the chain's locations. It comes on the heels of a year-long effort from union employees to reach a collective bargaining agreement with the coffee giant. Joining us now to discuss is Josh Idelson, labor reporter for Bloomberg News. He joins us via Zoom from San Francisco. Josh, good to have you with us this afternoon. Contextualize this number for us because there are a lot of Starbucks workers and there are a lot of Starbucks locations.
Thanks for having me. Yes, there are 9,000 corporate-run U.S. Starbucks locations. Of those, around 270 have voted to unionize, so a small percentage of the chain, but a stunning development by the standards of U.S. organizing campaigns at previously pretty much union-free companies. And of those, at this point, the union says 60 cafes are doing 3-day strikes. A few dozen others are doing 1 or 2-day strikes. And this is the latest effort by the union to mount pressure on the company to make a deal. We've seen now hundreds of stores in a few dozen states all over the country unionize, but as is the case also at companies like Apple and Amazon and Trader Joe's, those workers haven't yet won a collective bargaining agreement with management.
Well, I wonder if you can talk to me a little bit about what the big sticking point is specifically with Starbucks. What is in the agreement that, the coffee giant is struggling to get on board with?
So the workers have made proposals for pay increases, for putting a worker representative on Starbucks board, for preventing the company from cutting benefits, for restricting management from disciplining people without just cause. But at many of these stores, there have not been contract talks at all yet, or there was an initial meeting at which the talks broke down because the company objected to the union wanting to have some workers participate over Zoom, and the company walked out, according to the union. So at this point, both sides have filed claims at the labor board, accusing each other of refusing to negotiate in good faith. The U.S. Labor Board members have ruled at a Starbucks mega cafe in Seattle that Starbucks refused to negotiate as legally required by law. And so we have not seen much progress at all towards a collective bargaining agreement at the table.
Josh, how does this end? And how long does it go on for? Because it doesn't seem like Starbucks is really willing to budge, given what we've heard from them publicly. At the same time, it seems like the labor movement, and again, although it is still small in the context of Starbucks locations, it's gaining momentum.
So it is unlikely that we will see a contract happen in an ad hoc way at one or another cafe without a change in the overall posture of this conflict, because both sides recognize that any union contract reached at a particular store will set an example for the majority of Starbucks cafes that haven't yet unionized. So a bad contract would discourage unionization. A contract that really improves people's conditions would embolden workers to organize more. And so from early on, some of the architects of this campaign have said they don't expect to get a collective bargaining agreement, including in Buffalo, where workers first unionized, until there is some kind of national agreement with management that means the two sides are not as intensely at war with each other. And that is a very heavy lift for a union to win at a company like Starbucks. And so we've seen the union casting about for additional ways to put pressure on the company. And one of the things that is giving the organizers hope is the sense that Starbucks brand is important to it. And Starbucks brand is supposed to be as humane and ethical and progressive company. And if they can convince the public that the way the company is handling the union campaign and the union talks contradicts that, then that may be a vulnerability for the company.
That's so interesting, Josh. And I wonder if you can zoom out for us and give me a sense of kind of the pace of unionization efforts, across different companies and sectors. We were chatting with Sri earlier about some of the layoffs at Goldman, and he made the really good point that in 2021, when, the labor market was really strong, the big R word recession was a little further off, employees felt emboldened to bring up concerns a little bit more frequently. I wonder if the same logic applies to unionization efforts. Are we seeing a slowdown or a less of a push in unionization efforts as we get closer to a potential recession, or is it more of the same?
Well, in the big picture, the past year has really been stunning for the number of flagship, particularly prominent U.S. companies where workers have, for the first time, voted to unionize. Amazon, Apple, Trader Joe's, Starbucks, Chipotle. What happens over the next year is harder to predict. And workers at other locations within those companies and at other companies may be looking in part to see whether those workers are able to secure collective bargaining agreements. Now, one of the reasons why we've seen this wave of organizing over the past year is that we've had a tighter labor market, as well as the ripple effects of the pandemic in the sense of sacrifice that workers made and lack of confidence in the way that they were treated and protected or not protected by management. We've also had a relatively more favorable federal government for organizing efforts than existed more recently before that. And so some of those factors, as you said, have shifted. What remains is the viral example effect here. I've talked to workers at all sorts of companies. You have workers saying, it didn't really seem like it was a possibility to unionize my service sector job. And then I saw Starbucks do it.
Right.
And that's not going to evaporate overnight, even if the labor market becomes less favorable for workers to take on management.
I love the way you bring that up, Josh, too, because literally the virality of these things. I can't tell you the number of times I've seen Starbucks baristas talking about their unionization efforts on TikTok, on Twitter, and, getting classic customers that may not even know about these corporate struggles on board with their cause. I do have to talk about Trader Joe's a little bit. Tim, are you a Trader Joe's guy?
Yeah, but it's New York. It's so crowded.
It's
Nobody
so
goes
crowded.
there, as they say.
It's so crowded that you have to shop while you're in line.
Exactly.
But you're a good person, so of course you're a fan of Trader Joe's. Josh, I feel like if Trader Joe's can't do it, the company that's just known for having the kindest employees possible, if they can't do it, who can, right?
Trader Joe's also had conflict during the pandemic with workers who alleged they were fired because they raised issues about anti-racism and because they raised issues about safety precautions in COVID. And one of the things we've seen at a lot of these companies is workers saying that by organizing, they're trying to uphold the humane values that drew them to the company in the first place. Now we're at a point where 2 Trader Joe's locations have voted to unionize. Workers at one store in New York voted against unionization. Right. Union has brought claims of wrongdoing to the labor board against the company. And we're early in the negotiations at stores in Massachusetts and Minnesota.
All right, we'll have to see what happens. Josh Idelson, labor reporter for Bloomberg News, joining us via Zoom from San Francisco.
stocks, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks are well off session lows. However, we are on track for a losing week and a third day of losses for the S&P 500 index. Red on the screen, but let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bailey Lipschultz.
And good afternoon, Charlie. As you said, stocks are adding to weekly losses in a risk-off session as recession concerns mount. The Dow is down 270 points, S&P lower by 40, with the Nasdaq falling 95 points. The U.S. 10-year yield is at 3.48%, and small caps are down 15. All 11 main S&P sectors are trading lower, with real estate, consumer discretionary, and utilities each down by more than 1.5%, and Bitcoin fell 3% to drop below the $17,000 mark. Leaders in the Dow, Caterpillar, Amgen, and Boeing, while American Express, Nike, and McDonald's are the worst performers. After earnings, Adobe rallied as sales topped expectations. Accenture fell 5% after quarterly bookings were weaker than analyst estimates, and Darden dipped after weaker than expected margins overshadowed strong Olive Garden sales. In other news, Goldman Sachs may cut as many as 4,000 jobs, and Guardant Health plunged 25% after data from a study of its cancer test disappointed. Wrapping things up, Maxar Technologies soared after Advent struck a deal to buy it for about $4 billion. Peers including Planet Labs are rallying in the session. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
Okay, we thank you very much, Bailey Lipschultz. And to hear live breaking news over your Bloomberg, type Squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. Really do appreciate it. As I mentioned, we're continuing our coverage of the fallout of the collapse of FTX and the arrest earlier this week of Sam Bankman-Fried. Lawyers who are not involved in the former billionaire's defense telling Bloomberg News that SBF should come up with something different than, quote, I made mistakes, but I didn't mean to do it, for his defense. That being what he said in many interviews leading up to his arrest this week. This from a great piece by Chris Dolmetsch on Bloomberg.com and, of course, on the Bloomberg terminal. Right now, we've got with us Tony Saliba, CEO at Liquid Mercury, for our weekly crypto segment. Liquid Mercury is a tool for professional crypto traders that provides infrastructure, liquidity, and more. Some of their partners include Gemini, Bitfinex, Binance, Genesis, Kraken, and household names for those who do follow the crypto industry. Tony joins us via Zoom from Chicago. Tony, good to have you with us this afternoon. How are you?
Great, Tim. Thank you for having me.
Well, thanks so much for joining us. Hey, before we get into specifics about what you guys are doing at Blue Mercury, just full disclosure, were you guys affected at all, or were your partners affected at all by the contagion as a result of the collapse of FTX?
We had a couple staffers. As a company, no, we were not affected. We're connected to them, but we didn't have any real business going through them. We had a couple of staffers that had personal accounts. They actually were able to get their funds out in that little window from the first mea culpa. And in terms of some of our clients, we have a few clients that got nicked. I think across the board, Tim, the commentary is, not fun, but not damaging operations. And it just a lot of questions about FTX and the whole, access and nexus to crypto that, to me, it's really about fraud.
Well, we should note that Sam Bankman-Fried, he has been charged, but he remains in prison, in jail, I should say, in the Bahamas, but innocent until proven guilty. And we'll have to see how that plays out in court, Tony. You said you were connected to the FTX collapse in some way. What do you mean by that?
Well, so our solution connects to venues. We route orders to various market makers, OTC venues, and lit exchanges. So we had an interface with them in case a client wanted to trade on FTX. But we didn't have any financial connection or any accounts there. It was just another trading venue.
Fair enough, Tony. I want to go back to this idea that Sam Bankman-Fried needs a better defense than sorry. It reminds me so much of the story behind the Sex and the City Post-it breakup. Like, I'm sorry, I can't, don't hate me.
I'm sorry, I don't know what you're talking about.
It sounds a lot like a lame breakup note to me is, I guess, the point that I'm making. But going to you, Tony, I wonder how you rate Washington's response to the FTX saga so far. I was in D.C. this week for the hearings. Do you think that Washington gets it when it comes to crypto at this point?
Oh, my Lord. Well, on so many different levels, Carol, regarding that. I mean, my take on Washington is there are those who don't have a clue and those who are much more aware than any of us on this call, meaning why was he arrested the night before he was supposed to testify? And they don't want the information out. There's the whole underside of, allegedly. I mean, I think he's admitted to funding both political parties to some degree, but I think that what's happening in Washington is a lot of CYA and discussion about giving money to charity to paper over this. So I think there's certain people in Washington that know exactly what was going on.
How much damage, Tony, does this do to crypto, to what you're trying to do?
Exactly. That's the right question, Tim. So because the asset class was digital currencies, for the masses, the majority of the people just think, oh, that's, another black mark for that asset class. What I say unequivocally, because I was there, and that was when Enron's trading desk was discovered to be doing something untoward, and then more and more as the investigation went on, uncovered the fraud. We didn't stop trading in energy products. That asset class was not taken out to the woodshed. So
but energy is different than crypto because energy is a proven use.
Okay, I see. So, well, what happened with FTX doesn't go to that question. I think that's a fair question, Tim. But what happened here was over leverage, lack of oversight at a minimum, and seemingly some funny business, let's say, right? Allegedly, taking funds from a customer accounts is not, crypto related, except that exchange wasn't regulated.
Right.
When we got into this, we're from the traditional finance. So when we started, we didn't call any of these venues exchanges because they were trading venues. I mean, who out there that trades stock will be happy with an exchange being their executing broker and their market maker and the banker and so on and so on.
Tony Saliba, we are going to have to leave it there, but thank you so much for joining us on this Friday afternoon. Really appreciate you taking the time. Tony Saliba, CEO of Liquid Mercury, joining us via Zoom from Chicago. Liquid Mercury is a tool for professional crypto traders. It provides infrastructure, liquidity, and more. Let's get on over to our Bloomberg TV simulcast. Mike McKee is standing by, and he's got a big interview coming up right now with Cleveland Fed head Loretta Mester.
Good afternoon. I'm Michael McKee. A half hour until your weekend. But before you sign off your terminals, we have a very special guest for you. Welcome to everybody tuning in on Bloomberg Television and Radio and everybody watching Bloomberg Business Week on YouTube. Joining me now is Loretta Mester. She is the president of the Federal Reserve Bank of Cleveland. Thank you for making time for us here. I know you've been quite busy lately down at the Federal Reserve. So I'll start with an easy question. What is your forecast for the federal funds rate at the end of 2023?
Well, that's an easy question. So I'm a little bit more, a little higher than the median in the S&P because I see a little more inflation persistence than the S&P. And so I think that's the key point. The committee's path in the S&P, I think, is very valid. We need to continue to bring up interest rates into a restrictive stance. We did a lot of work this year in getting expeditiously to a restrictive stance. Now we're just starting that, bringing rates even higher. And I think we're going to need to be there for a long, quite a while in order to get inflation on a sustainable downward path. So my path is a little bit stronger than the median path next year. The median had it between 5 and 5.25, and I'm a little above that. But, the message from the SEP is we have to continue to raise rates because we have more work to do on inflation. Inflation, although we've had some welcome news, is still too high, and we need to do what we can with our monetary policy tools to bring it down.
Well, that raises the question of why you and your colleagues raised your forecast for where the inflation rate will be, the PCE inflation rate, at the end of 2023.
Well, we put in the forecast, the last SEP in September, and the accumulated evidence shows that inflation did run a little higher than we had expected it to run this year. So we're starting at a higher level. And so the work that we're doing with interest rates over the next year and the following year is really going to get inflation down. So if you look at the SEP, there is a material improvement in inflation next year, not back to 2% yet, but at least coming down. And then we'll have to adjust policy to ensure that inflation is sustainably down back to 2% after that. So that's what the job of the Fed is, to make sure that we get that inflation moving back down. And that's what our policy path in the SEP conveys, is that we're very committed to getting back to 2% inflation and price stability.
Well, we had two soft CPI reports and a PCE report that was lower. Did that not figure into your thinking?
Well, of course it did. That was welcome news. It's great to see some of those monthly increases move down a bit and temper. But right now, my read is that the evidence just suggests that we see tentative signs of inflation stabilizing. I haven't seen a lot of evidence that service prices have moved down yet. We have some tentative signs that housing, if you look at the rents and new leases being signed, they've moved down. And Cleveland Fed Research says that takes about a year to show through to the CPI and PCE rent part of those indices. So that's a good sign. We've seen goods prices and commodity prices move back down. That's a good sign. But we know that service price inflation is what's really persistent, and we haven't seen much improvement there. So again, the level of inflation is still way too high. 7.1 on the CPI, 6% on the PCE measured year over year. That's well above our goal. And so that's why we have to continue using our tools to get inflation on that sustainable downward path. And I expect to see some volatility in the monthly numbers. That's why we need to see really consistent evidence and cumulative evidence that inflation's moving back down. We haven't seen it yet, although I don't want to discount the good news that we've gotten in those last couple of inflation reports.
But it sounds like you did not change your SEP inflation forecast after the CPI report on Tuesday.
No, because it was roughly what I anticipated it to be. It wasn't a surprise. We've been saying that we should expect inflation to stabilize and then move back down, and the goods parts of that report was pretty much in line. So again, I didn't think of it as that much of a surprise. I was glad to see that the monthly pace had moved down, but I didn't think of it as being inconsistent with the forecast. It does give you a little more evidence of confidence in your forecast when you see data coming in consistent with it. But, given that we've missed on the inflation forecast quite a bit, and not just the Fed, private sector forecasters did as well, again, we have to be a little bit humble about our forecasts and let the data come in and judge what the path of inflation is going to be. That guides our monetary policy decisions.
If you know, as you suggested, that contemporaneous measures of rent are coming down and that it takes a while to get into the CPI, why not just look through the housing component of CPI and PCE and think of inflation ex housing, as Jay Powell has suggested?
Well, we look at all, our goal is in PCE inflation, year over year PCE inflation of 2%. But we look at a lot of different indicators because those indicators tell us the direction of inflation. So we have to look at housing prices. That's a big chunk of what people pay for, right? A lot of times people say, why do you look at core? You're taking out food and energy. That's a big part of my basket. And you have to explain, well, our target includes those, but when we're trying to figure out the direction of inflation, where it's going, sometimes food and energy prices are a little bit difficult because they're so volatile. Now, we have inflation high, the goods prices are coming down, oil prices have come down, But again, we just have to see a more cumulative evidence that inflation has indeed peaked and that it is moving back down. And it's just going to take some time for inflation to get down. We know how persistent it's been. And, we just have to do our work to make sure that inflation is going to get back down to 2%. And that's what we're doing.
One of the things that's confused people on Wall Street is the idea that you, on the Open Market Committee, raised your forecast for PCE core inflation at the end of 2022 to 4.8%, which means you'd need a 7/10 increase in that in December to get there. And mathematically, that's only happened once since 1981. Do you really think we're going to get a 4.8% read?
Well, remember, that's the median of of 19 different projections, right? So you can't say that median necessarily is a particular person's forecast. But I think the way I would look at the SEP is inflation has been a little more persistent than we thought in September, and that's why the numbers moved. And if you look at all the numbers, I think you get a better sense of where things are going. So, a little bit more inflation persistence coming down next year, and a material change in inflation next year. And then unemployment moves up a little bit because we're slowing the economy in terms of the demand side of the economy. And that'll also slow some of the labor market indicators. And then we get back to 2% inflation, but it takes a while. So I think that's the way I look at it. Remember, the median path and the median forecast, and there are not one person's forecast. It's a way of summarizing a lot of different forecasts.
Well, to get back to what you said earlier about leaving rates in place for a long time, earlier today, Mary Daly and John Williams both suggested that you're going to have to leave rates in place for maybe 11 months or so. Mary Daly said that's the historical pattern from the peak, but you wouldn't get there until March or May, so we would be well into 2024 at that peak rate. Should Americans be prepared for high interest rates for that long?
Well, I think we should be prepared for high interest rates. I mean, the exact timing of when, it'll be appropriate to, move rates down really is not tied to a calendar. It's tied to have we seen evidence and good evidence that inflation is on that sustained downward path to 2%. So, you can go back in history and look at, how long things will have to be where they are. But we're basing our forecast, and I'm basing my forecast on my projection of where the economy is going to be. So when data comes in, when people say, are you data dependent? I say, yes, I am. But it's the data coming in. And I mean data and anecdotal evidence that we get from our business contacts and our community development contacts in the district. That informs my outlook. And then I base my policy decisions on that outlook. So my own outlook is that we will have to keep the funds rate up above 5% next year, right? And until we get inflation moving back down on that consistent basis, and then we can move into the next phase. So we're really basically done one phase of policy. One phase was, let's get expeditiously to the start of a restrictive stance. We did that this year. Now we're in the second phase, which is we're going to move into restrictive territory and a sufficiently restrictive stance in order to get back to price stability in a timely way.
Let me ask you right there, what is a sufficiently restrictive stance?
Right, and that's what the data or the evidence in the SEP tells you, that most people on the committee believe that, I think 17 out of 19 believe that it will be above 5%. It's going to be informed by both how fast is inflation moving back down, and it's going to be informed by how much is demand and supply coming into better balance, which then alleviates alleviates those price pressures that we've seen rise so much over the past year. So that it's data dependent in the terms of we're going to let the data come in and we're going to have to use that data and evidence to inform our outlook. Right now, our best evidence is, and our models and our talking to our contacts, is that we're going to have to move rates up ongoing increases from the current rate to above 5% and hold there for some time in order to get inflation back down to 2%. And that's what we're about doing right now.
Well, let's talk about what you do see in the economy for 2023. The SEP median is for 0.5% growth, which economists would tell you is basically forecasting recession because you're splitting hairs with 0.1% growth there. Do you see any contraction in 2023?
So I didn't pencil in a contraction in my SEP, but I did pencil in growth that was well below trend. And when you have growth, as you say, well below trend, it won't take much of a shock to push you into a negative couple of quarters. So I do see growth slowing. But remember, that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures. And I do see the unemployment rate going up a bit next year as well, again, but inflation is coming back down at 2. So the mechanism through which monetary policy is going to get us back to price stability does entail slower growth and some increase in the unemployment rate in order to get that balance that we're seeking to get inflation back down and get back to price stability. So I don't want to discount that in terms of the pain. But right now, we're trying to move our policy in the way to get back to price stability, but in a way that minimizes the pain of the journey.
For many on Wall Street, the question after your meeting was, did the Fed underestimate the persistence of inflation, or is this really an effort to try to halt the loosening of financial conditions that's happened over the last couple of months?
Well, so, there's two reasons that the market participants might have a different view than the Fed. One is they don't understand what the Fed is doing. I don't think that's the case. I think we've been very clear. The SEP gives you some numbers attached to our forecasting. And I think we've been very clear and transparent about how we're seeing the economy and where we see monetary policy needing to be in order to get inflation back down. And I don't think anybody appreciates the fact that we're very committed to getting inflation back down to 2%, and we will do it. I think there can be differences of forecasting, right? The market might see inflation coming down sooner than we do, and therefore they'd have a different view of what appropriate monetary policy is. That's why we're all data dependent, right? They're looking at the data, we're looking at the data as well, and that informs our outlook for the economy and the risks around the outlook. And we're doing that work in order to get inflation back down. So again, you can have differences. I think, we're doing the best job we can in terms of explaining what we're trying to do and why we think this is a good path to be on in order to get back to price stability. And I do want to underscore that it's very important for the economy to get back to price stability, because leaving inflation at these levels for long is just very costly in terms of the near-term economy, people having to pay those higher prices, but also in the long run. It really distorts decisions that can really affect the economy in the long run. And that will not be good for labor markets in the long run either.
Well, I have one last question for you along those lines. When the market is fighting the Fed like this, they refer back to the so-called Fed put. If the market continues to fight the Fed, who wins?
Well, I don't necessarily see it as a fight. I mean, we take signals from the market because they also are forecasting. And we have very many models and great economists who are working to forecast as well. And when we take all that information, then we set our policy appropriately. So, one of the mechanisms through which monetary policy transmits to the economy is financial conditions. And so that's why we watch them very carefully. But again, I think our job is to be very clear about our intentions, what we're planning to do with policy. And we will be basing our policy depending on where inflation is going and what our forecasts are for inflation and for the labor side of the market. So again, we can be transparent. We're not prescient, obviously, but my hope is that people understand that they see that when the data comes in, we're actually going to respond to it in the appropriate way.
Loretta Mester, the president of the Federal Reserve Bank of Cleveland, thank you very much. We know you're going over the river and through the woods for the holidays, so safe travels. And we thank you for joining us here on Bloomberg.
Thanks, Michael. Happy holidays.
And a big thank you to Bloomberg International Economics and Policy correspondent Michael McKee there with Cleveland Fed head Loretta Mester. Just a quick recap of some of the big headlines from that interview. Loretta Mester is saying that we need to keep Fed funds rate above 5% in 2023 to curb prices. And leaving inflation at these levels, though, for long is costly. Loretta Mester also saying a rate cut timing is tied to evidence of slower inflation and need cumulative evidence that inflation has peaked. Bloomberg Business Week is brought to you by Audi. Don't let someone else drive off in the Audi model you've always wanted. Visit your local tri-state Audi dealer to get behind the wheel of yours today, or visit AudiOffers.com for more information. Let's head over to Charlie Pellet. He's standing by in the Bloomberg newsroom. Charlie, we got a little over, 10 minutes to go until the close today?
13 minutes, Tim. With the Dow, the S&P, NASDAQ, we're all off session lows right now, but red on the screen with the S&P down 0.9%. After the Loretta Mester interview, we have got the 10-year yielding 3.47%, the 2-year 4.18%. Cleveland Fed President Loretta Mester telling our Michael McKee her estimate for interest rates is higher than that of her colleagues, and the central bank needs sustained type policy to defeat inflation. Mester interviewed moments ago right here on Bloomberg Radio.
The level of inflation is still way too high. 7.1 on the CPI, 6% on the PCE measured year over year. That's well above our goal. And so that's why we have to continue using our tools to get inflation on that sustainable downward path.
And again, 10-year yielding 3.48%. Gold up $17 the ounce, now $17.94, up by 1%. And West Texas Intermediate crude down 2.4%, $74.26 a barrel. So it is a down day on Wall Street, looking for a second week of losses for stocks, third down day in a row. Recapping, S&P now down by 0.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. Just drive, baby.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
It's the Drive to the Close. We got a little over 10 minutes to the close of equity trading here in the U.S. on this Friday, December 16th. And we're seeing a little bit of buying into the close here. We're off of the worst levels of the day. The S&P 500 down 0.9%. It was down as much as 1.74% a little earlier in the session. Really curious to hear what Marianne Bartels, our next guest, has to think about all this. Chief Investment Strategist and Managing Director at Sanctuary Wealth. Marianne Bartels joins us on the phone from Nyack, New York this afternoon. Marianne, how are you?
I'm terrific. Thank you for having me today.
Are you terrific? Today's it's been quite the week when it comes to the equity market. I like the perspective, but how are you feeling?
I'm actually feeling pretty good.
Why?
I have a little bit more of an optimistic outlook for 2023. Now, we still have some bumps in the road. We're going to have some volatility. But I think if we were to have this conversation this time next year, I think everybody's going to be a little happier in their portfolios.
Okay, well, give us a prediction about how much happier they'll be.
A lot.
Okay, wow.
So
what, like 20% happier?
Well, we think the bull is already running, and it's not getting a lot of conversation. And that's in the equity market, and it could already be running in the bond market as well. So what do I mean by that? One of the things that I learned early in my career is when you're in the bear market, the bull starts running. It starts showing its colors, and you're seeing that in the energy sector. You're seeing that in the industrial sector, the material sector, and parts of the healthcare sector. We have stocks in those sectors that are trading at or near record all-time highs. And we keep talking about a bear market. Well, there are pockets that are not in a bear market.
Okay.
Interesting.
Well, we'll have you back in a year, but we'll have you back before then, certainly, to check in on that, right, Maddie?
Absolutely. Well, I have to say I love the positivity, but I am kind of reeling from Mike McKee's recent interview we just had on TV and here for our listeners with Loretta Mester from the Fed, very hawkish, saying that we need to keep fund rates above 5% in 2023 to curb these prices, saying that we just have to continue to get this inflation down. But it feels like the market is kind of fighting the Fed. Marianne, can you talk to me about who wins that fight and why we're seeing the market reacting the way that we are?
Well, you're absolutely right. You're seeing the bond market really fight with the Fed. And what the Fed on average is forecasting is that terminal rate just above 5%. And the market has that number 75 basis points below that. Now, in the equity world, we've always learned not to fight the Fed. And if the Fed is going to continue to raise rates, and they are going to continue to raise rates in early 2023, that's going to create volatility for the equity market and the bond market. But if you look at the bond market technically, the bond market is saying that they're successful, or the bond market believes they are in the early stages of success, because inflation numbers still are very high. Even though CPI came in less than expected, it still came in at 7%. That's not the number that anybody wants to see. So it's going to take some time to get that number down. But what the bond market is trying to suggest is that the tightening that the Fed has done will have a positive outcome.
When, though?
Sometime next year.
Sometime next year. So does that mean that we'll start to see?
Sometime next year.
So does that mean that we'll see in the Fed hit its inflation goal of 2% sometime next year?
I believe it can. If you look at the chart of CPI year on year, and you go all the way back to the 1950s, the pattern is more reflective of the 1950s than the 1970s. In the early 50s, we saw CPI actually get up to 10% and then fall sharply. And what's also interesting about that time period is 10-year Treasury yields traded around 2.5%. And technically, I believe the 10-year sometime next year can hit 2.5%. So I think some of the similarities might be a little bit more to the 50s than it really is to the 70s.
Well, we've also, another kind of data point I like to look at is that we've never had a recession where we have not seen earnings dropping by 20%. Are we on our way to that in your view, Marianne?
That's a great question, because that's what's perplexing the market. Strategists have taken their earnings numbers down, but when you aggregate the S&P 500 and their earnings, they're actually still positive for 2023. So there is a lot of concern that as we move into next year, earnings will have to come down, and that's going to take the market down. Now, we are looking for the S&P 500 to go back down and test the lows of October. And where we see the problem in the market, and there is a bear in the market, it has not hibernated, is in the big growth stocks, in the tech names, and the FANG names. And that's where the market cap of the market can come down, and you're not seeing this bull run because they're not just impacting the indexes yet.
Wait, I want to make sure I got this right, Marianne. You said we could test the lows that we saw in October?
That's correct. That's around 3,500, slightly below.
Okay.
Yeah, I think we can, and I think we're in the process of doing that now. We haven't been looking for the Santa Claus rally, and the reason for that is we think Santa Claus came early. In October, if you recall, the markets were up substantially relative to history. Normally, October does not have a great rally. So we think Santa Claus came early, and that it's going to be a very volatile month of December, a type of month that we're not used to in December.
What are the big events that you're going to be looking to next week and through to the end of the year? Obviously, this week we had FOMC, all the central banks today, triple witching. What's coming next that you've got your eye on?
Well, I think, everybody's going to keep watching data and anything that's sensitive to prices. We are seeing, manufacturing cool off, housing cool off. The consumer has really been holding everything together. Wages have been going up. So I think any data points with housing.
Can I ask you about that, actually, Marianne? I have a housing question for you, if you have a second. Sure. Do you care much about Zillow's data? They've been tracking rent over the past 7 years, and they've got a great data point out this week that rents are going down by about 0.4%. I know that's really small, but does that give you an indication as to where the housing market is going? Do you look at data like that?
Absolutely. I think anything that's timely that you can get a sense of where current prices are, I think are a valid data point. Now, do I think the Fed's going to use that input? Maybe, maybe not.
Fair enough. That's
Okay.
helpful, though. That's helpful to know.
So, apart from energy, industrials, materials, parts of healthcare, are you bullish at all in other spots? I mean, you said that we could start seeing tech get hit even more. Is there a turnaround for tech that you see in the near future?
Not really.
Why is that? I thought tech was here to stay.
Well, I believe in the digital era. I believe in tech longer term. I think their valuations just got way overextended. In a higher interest rate environment, you can't sustain these high level PEs. So I think you're going through a PE adjustment. I think eventually you're going to get terrific, bargains. You'll get 20, 30, 40, 50, 60% off depending on which company you're looking at. But I don't think we're going to probably be looking to buy them for maybe at least a year. But the other pockets of the market that I think will stay favorable are dividend yielding stocks. We still have a lot of baby boomers. I was recently out meeting with clients, and they want dividends in their portfolio. And yes, they're happy to add fixed income. You can even diversify in cash now and get over 4%, but they still want their dividend paying equities.
All right, Marianne, we're going to have to leave it there. Really appreciate you taking the time and joining us on this Friday afternoon. Some great perspective and also just some nice glasses half full optimism to end the week on. Marianne Bartels, Chief Investment Strategist and Managing Director at Sanctuary Wealth. Don't go anywhere because we're going to be joined by our friends at Bloomberg TV for our Beyond the Bell coverage in just a few minutes. This is Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Katie Greifeld, counting you down to the closing bell, here to help take us beyond the bell. It's a global simulcast with Tim Stenovic, Madison Mills in today for Carol Master. We welcome our audiences across Bloomberg Television, radio, Quick Take, as well as on YouTube. An interesting day, a volatile day, Tim, and I think that volatility really underscores a lot of the mood music that we saw all week long.
Yeah, Marianne Bartels from Sanctuary Wealth, who we just spoke to, said get used to the bumps in a road, that volatility. We're going to continue to see that for a little bit longer, but she did say in about a year, a lot of people are going to be a lot happier. She thinks that the bull is already running when it comes to the equity market right now. She pointed to industrials, materials, parts of healthcare, and energy. And she was really optimistic, you guys.
But so is she talking about specific sectors, though?
Yeah, specific sectors.
Okay.
And she said that the Fed can hit its inflation goal of 2% next year. In 23, she thinks the Fed is going to get inflation down to its 2% goal.
Yeah, it was really jarring coming off of the interview with Mester, really hawkish going into that conversation with Marianne. She talked about some of these positive signs coming into the market. She also talked about rents going down. We talked about some Zillow data, which I know is kind of small potatoes for us, but Zillow showing that rent is finally starting to taper off a little bit with 0.4% drop in rent over the past month.
I got to say, I guess what makes a market, the fact that you do have someone so bullish out there. I got to say, though, there is a lot of daylight between 7% year-over-year CPI and 2%.
There is. She did say that we could retest those lows on the S&P 500 that we saw in October. So it was a pretty big caveat.
Yeah, I mean, still a lot of concerns here, I think, about valuation, and I think that has to be rectified as well. You're still paying more than 2 times next year's sales, and the PE ratio going forward also not necessarily back down to where we were before, more than 17, 18 right now on the S&P. As for the roundup here on the daily numbers, the Dow Jones Industrial Average lower on the day by about 0.8%. The S&P 500 down about 1.1%, and the Nasdaq Composite going to close out the day down 1% on the day. Similar story for the Russell 2000, though it was a relative outperformer, only down about 0.6%. But you put it all together, all of the major indices and averages here in the U.S., Tim, lower on a weekly basis.
Yeah, and we didn't finish on our lows for the S&P 500. It was down as much as 1.7% a little earlier in the session. Still, though, 420 stocks moved lower in the S&P. Only 84, Katie, were in the green.
I have some sad news. If you look at the industry groups, there's 24 of them. Media and entertainment was hanging on for a long time, but it slipped in just the last half hour or so, finishing about 0.7% lower. Of course, that is the outperformer on a day like today when you have all 24 in the red. You look down there at the bottom, it's autos down 4.7%. A lot of those declines coming just from Tesla.
All right, Katie, well, I'm going to come in with a couple of positives today. We've got some gainers here. Meta, of course, rising as JP Morgan raised the recommendation on the stock to overweight from neutral. That stock rallying 31% since November lows. We also have Adobe coming out with earnings yesterday. That forecast encouraging investors. It held on to its annual sales forecast, which is notable on a day in which we're seeing so much red. And then, of course, we've got Netflix, which we talked about a little bit earlier, having so much whiplash in 2022. In the first half, it was one of the worst performers, down 71%. Now in the second half, it's the second best performer, up by 67%, Tim.
Oh, look at that.
Pop quiz here, Maddie. What's the best performing stock in the S&P this week?
Don't worry, Maddie. Nobody ever gets this right. Don't worry.
Week, I mean, I feel like the stock that I'm looking at the most this week is Tesla because they've been just so down and so up.
Yeah, well, that's one of the worst performers. One of the best performers. It's Fortune Brands. They make all, faucets and all
Don't
that
worry,
other
Maddie.
stuff there.
You're in good company.
Yeah.
Okay.
All right, Tim.
All
What do you
right.
got? Prepare yourself.
Well, Maddie mentioned Tesla. We got to check in on Tesla. It has its worst week since March of 2020. It dropped 16% this week. It's firmly below that $500 billion in market cap, down 4.7%
Really?
today.
Are they selling fewer cars? What's happening?
I mean, there are a host of issues, Romaine. We can start with weakness in China, concerns about competition. And then, of course, the big one that I see is what's happened over the last couple of months since that deal closed for Twitter, and what Elon's been doing over at Twitter. In fact, shares at Tesla are down more than 30% since Musk's deal for Twitter closed back in October. Keeping an eye on shares of Amazon, it actually performed better than the S&P 500, despite the fact that JP Morgan cut its price target from 145 to 130. This over concerns about AWS revenue deceleration and margin compression amid challenging macro conditions. And then worth checking in again on shares of Novavax, falling 2.6% today. It was down double digits earlier in the session, and it comes after yesterday's 34% decline. That was after the company announced it had cut its vaccine supply to the UK and was seeking additional equity and debt. That came today. It announced the pricing of an underwritten public offering to sell 6.5 million shares at $10 per share. Shares closing today at $11.03, Romaine.
Point out Tesla, the second worst performer in the S&P on a weekly basis. Worst performer, that actually belongs to Charter Communications, actually having its worst week as a public company here.
Okay, Romaine, I'm glad you brought that up.
Yeah.
Were you surprised to see Charter's investment?
Yes.
How big that was?
Yeah.
Given we're in a high interest rate environment and high rates are supposed to cause companies not to spend so much when it comes to CapEx?
Yeah, but Charter's kind of in a rock and a hard place. I mean, and to a certain extent, they have to spend that money. I mean, this is long-term spending, to be sure. I think the first year of spending kind of scared some people. It was definitely well above what the street was looking for. I think it was $1 billion more.
Yeah.
So maybe that caused some people some concern. But like I said, if you're the management team over at Charter, if you're the board over at Charter, I mean, you really don't have much choice. You got to do this if you want to sort of thrive. I do want to go quickly here to the bond space here because we did see treasuries all over the map this week. On a weekly basis here, the change wasn't too dramatic here, but it really obscures some of the volatility. Right now, a 2-year yield right around 4.2%. Your 10-year still camped out right around 3.5%, and the 30-year right around the same. The big question is now as we head into 2023 and people need to start repricing a higher terminal rate, which last time I was checked was 5.1%, and I'm looking at a 2-year yield right now is at 4.2%.
That's the thing, and the fact that we're seeing the 2-year yield actually fall a little bit today, that tenor actually rally, when we've heard from 3 different Fed speakers who didn't sound all too dovish to me. They really towed the party line there. The fact that you're seeing a little bit of a rally there, anyone's guess.
Did we see the bond market call this earlier this week, guys? Did we see they sort of got it right when it came to the way that investors were thinking about the economy, right? Yeah. We saw bond yields move in a way that stocks didn't move earlier this week, and we didn't see stocks catch up until the last couple days.
I have to crunch the numbers, but I would challenge you on this. If you look at the last time we saw meaningful outperformance in terms of price outperformance for the longer end of the curve versus the shorter end of the curve, and I think that's telling because that does, I mean, depending on if you're a glass half full, glass half empty kind of person, that might be a signal that the market is preparing for a recession.
I mean, if you look at what the market is pricing for next year, I keep coming back to this. The fact that there are cuts priced for next year, the fact that you are seeing the long end rally to the extent that it has, that has to be a recession call on some level. What else would cause the Fed to cut when they've been so vehement that they're not going to?
Well, if you think if inflation is actually going to get back down to a 2% target in less than 12 months.
Like Marianne Bartels
But
just
even
told
if
us.
it did, I mean, we just heard from Mester to get it down there, they're going to need to pause and then hold for a long time. Again, that's their expectation, and we'll see what actually happens.
Were none of you encouraged by the CPI data, PPI data that we got? And of course, we get a big PCE number next week. I mean, the trend has been down. It's still high, but the trend has been down.
The trend has been lower, that's true.
Yeah.
It feels though like the market doesn't care, right? It feels like, I mean, Mike asked the perfect question. If the market continues to fight the Fed, who wins?
I think the trend in some data is going in the right direction, but I go back over and over again to the labor market and the continued tightness that we see in the labor market. If we continue to see it there, Romaine, then we're going to continue to see wages move higher, and that could lead to continuing inflationary spiral.
And we talked a little bit earlier this week about the whole boomerang effect when it comes to inflation. The idea that a lot of the sort of volatility in inflation is because spending is continuing. It's just sort of moving from one sector to another. I guess the question is it sort of like musical chairs and all the chairs get pulled off and eventually it all sort of breaks down, or is it just going to continue to be the rotation?
And what that rotation actually means when you're thinking about the headline number, maybe it's okay if the rotation is quieting down all at once, but
Yeah.
go on.
Go on. Oh, sorry, I didn't mean to interrupt you, Katie, but it's just kind of what I do. I'm curious, though, before we leave, guys, and I'll start actually with Maddie, since you're our exalted guest today, in the Queen's chair, by the way. Be respectful of the Queen of New Jersey, and I'm not talking about Katie. I am curious, Argentina, France, who you got?
I mean, I'm always voting France in any scenario. I'm always on France, But I will be up early watching all weekend.
Are we talking about dressage?
The only person on this panel who's more out of their element when it comes to this conversation is maybe Katie.
Can we talk about bonds more, please?
She's begging. She's begging to talk about you.
Can I just tell you, we had a meeting, our show meeting, where we kind of planned out all the top. All Katie talked about was horse stuff. She wanted to do dressage.
She's a horse girl.
What is it? What is the little chariot things you guys do? Steeplechase?
No,
that's all she talked about.
Steeplechase.
If she takes over their show, that's the whole show.
In any
it's just
case,
horses.
is it 4:08 p.m.?
It is. It is. I'm sorry.
We're both in luck, Katie.
Perhaps, viewers and listeners will be delighted to know we're done with our simulcast. That is going to do it for our cross-platform coverage, at least this Friday afternoon. We are going to be back on Monday, same time, same place. Have a great weekend, everyone. Happy holidays if you are going on vacation. This is Bloomberg. That this year, the city is expected to host 56.4 million visitors. That's up from 32.9 million in 2020, which of course saw the onset of the pandemic and a huge decline in international visitors as well as domestic ones as well. Next year, the organization, though, expects visitors to surpass those 2019 levels, officially declaring New York on the rise once again. We've got with us Tiffany Townsend, Executive Vice President for Global Communications at New York & Company, joining us this afternoon via Zoom from New York City, of course. Tiffany, how are you?
I'm doing well. That's right. Joining you live from New York City. It's good to be with you guys. Thanks for having us.
It's good to have you with us this afternoon. So talk to me a little bit about what you're seeing when it comes to the data, because I was on New York & Company website earlier, and you have a host of just fantastic data about tourism, visitors, how much people are spending, how important this is to the overall economy. What makes you think that 23 is going to bring us back to levels that surpass 2019?
It's really just the activity we're seeing. I think there's been a lot of pent-up demand for travel ever since, the borders had started opening, and really even before the borders started opening. I think we'll hear people talk about things like sort of revenge travel, wanting to compensate and make up for lost time. And I think that's really what we're seeing. I think there's always been a desire for people to come to New York. It's sort of an aspirational destination. So people want to make their first trip and then they come back and they want to come back again. New York is a very dynamic place. It's always changing. And so we like to remind people that even if you've been here 5 times, that next time you come is going to be very, very different. And so I think the numbers are really beginning to bear that out. Right now, we're expecting that by the end of 2022, we'll see about 85% of our visitation return, and that's 85% of what our record high was of 66.6 million in 2019, just before everything closed. And so we're still on track to see that. We like to sort of leave a little space at the end of the year, because the holiday season between Thanksgiving and New Year's Eve and New Year's is really a time when we tend to see about 30% of our incoming visitation. So there's a huge influx of travelers to New York City at this time of year. And so by all the indicators that we're seeing, we're going to see about 85% of that visitation return for this year. And that really puts us in a great position to go into 2023 with even higher numbers.
It's really interesting, Tiffany. It sounds like you're not having any sort of negative impact from a rise in COVID cases, flu cases. We're still seeing a lot of visitors this year.
We're certainly seeing a lot of visitors this year. In this holiday period, we can expect to see about 6.5 million people, and that's across both domestic and international. And certainly the city has taken, I think, a very proactive approach to providing both protocols and information for both residents and visitors in terms of any concerns or hesitations that they may have about traveling to New York City, with COVID cases still being something that's top of mind for everybody.
What about the holidays, right, in these next couple of weeks? And to what extent we're actually seeing a return to 2019 levels, or what you predict now? I mean, are we 100% back?
We're not 100% back, but we are getting there. New York, it certainly has returned. So we will see roughly 6.5 million visitors between now and New Year's Eve. And so that really does put us on a continued upward trend, which we have seen throughout this year. And we also saw it in 2021. You will remember that the borders opened for a number of countries, or right around just a little bit over a year ago. It's probably about November or so. And so, as restrictions continue to ease globally, that will only continue to bolster and help create that continued influx that's going to get us back to that full recovery.
I've got a question for you, Tiffany, as we sit here in Midtown, which is also the neighborhood I choose to live in. Nobody really understands why, myself included. But
because you can walk to
because
work.
I can walk to work.
It's amazing.
Because I can walk to work, because we got a Trader Joe's here. But I wonder if the death of Midtown, quote unquote, is impacting holiday activities, tourism at all.
But talk about what you mean by that, Madison, for people who don't spend a lot of time here. I mean,
Sure.
you do walk around you walk around this part of the city, and
Yeah.
it doesn't look like it looked back in 2019.
It's a ghost town. I mean, I used to thoroughly enjoy my afternoon shopping breaks at the Zara and American Eagle across the street that have now just become these empty building mainstays of the neighborhood. But I do think of Midtown as a really good go-to spot for a lot of these holiday activations. You've got the Christmas market, you've got Rockefeller Center, of course. Are we seeing more people flock to this neighborhood of the city to enjoy those holiday activities, or have we seen that the business crowd working from home is having an impact on that?
Well, you are still seeing that people are continuing to work from home. I think, sort of the office experience as we know it is forever changed by the pandemic. But I think that is a little bit, there's a little bit of separation between there and what we're seeing for overall leisure travel. And we obviously do make the distinction between how leisure travelers behave and business travelers behave. I will tell you on a personal note, I was in Midtown last weekend.
I'm sorry, Tiffany.
It was quite full, which is something that I happen to love to see. And so So I think that we're certainly seeing that influx. There are a lot of activations that are taking place throughout the city, certainly on Sundays in December, to also help sort of manage the crowds and continue to invite people in. There are open streets. I think it's from 12 to 6 on 3 Sundays in December. And I think that's a great way to sort of encourage people to come back. And then you have that space along Fifth Avenue to roam and to shop and to see the tree and to see the windows and to see the lights. It's just really sort of the magic that is New York City at this time of year.
Okay, so I was digging into New York & Company, New York & Co., doing some research ahead of this interview, Tiffany, and I had a hard time understanding who exactly funds the organization. 2,000 member organizations, I know, fund it. Are those member organizations Are they businesses? Is this an association that is supported by businesses within the city? Is it taxpayer funded at all because of the economic impact that tourism has on New York?
Well, we're a not-for-profit organization, and part of it is that we are a membership organization. So to your point, all of the cities, all of the businesses and sort of everything that makes up tourism is a part of who is our membership. So it's the hotels, it's the museums, it's the attractions, the tour operators, et cetera. So it is a wide variety, but the best way to sort of help you think about that and give it perspective, it is really all of those businesses and all of those organizations that make your travel experience what it is and sort of contribute to that. And
but
so
is there any public funding? Is there any partnership with the city of New York, the mayor's office?
Yes, we do receive some public funds as well.
Is that from the city or from the state?
From the city primarily.
Cool. Makes sense. Thank you for clearing that up for me. Kind of hard for me to find.
No problem. Happy to.
No, it's really interesting. I think Tim is asking the hard-hitting questions here. I just want to know how Tim and I
Where do you get your money?
I just want to know where to spend my time in this incredible city that I love so much. Tiffany, Tim and I are both going to be working the entire week between Christmas and the New Year.
I'm sorry to hear that.
any big fun events that you think that we should keep our eyes on, that we should try to play hooky from the chair here and experience?
Well, I would say, I mean, if you're in Midtown and you haven't done the tree in Fifth Avenue and the windows, like do that. That is like the easiest thing. You can run downstairs, right between segments, or before your show starts, and see the windows and see the tree and see all the lights. But there are a lot of, there's always a lot of pop-up activations. I think you alluded to this before. Flatiron, the Flatiron area and sort of Madison Square Park has that. Out in Queens, there's a new Amaze light exhibit over at Citi Field.
I've never done that.
So that's really exciting. You have the classics. You have up at the Bronx Botanical Garden. You have the train show. That's 30.
I already have tickets for that, Tiffany, for January.
Oh, you do? Excellent.
Taking the toddler. They're hard to get tickets. You got to get them early. The thing is so popular. Tiffany Townsend, Executive Vice President for Global Communications at New York & Co., joining us via Zoom from, of course, New York City. You're listening and watching Bloomberg Business Week.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Stocks end a jittery week lower as those Fed hawks circle. You heard Loretta Mester live here on Bloomberg Radio. Stocks suffering their longest weekly losing streak since September as investors remain concerned that the Fed's resolve to keep raising rates could tip the U.S. economy into a recession. So it was a down Friday for the week. The S&P was down 2.1%. The Dow this week down 1.6%. NASDAQ this week down by about 2.7%. S&P fell 43 points to end the week, head into the weekend at 3852, a drop of 1.1%. The Dow today down 281, down 0.9%. NASDAQ was down 105, down by 1%. To be sure, though, stocks finished well off session lows. 10-year yield 3.48%, with the 2-year yielding 4.18%. Gold up $16 the ounce to $17.93, up 0.9%. West Texas Intermediate crude down 2.4%, $74.31 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
For that. Now, global venture investment has fallen in 2022, but one company targeting a historically underserved market managed to get $50 million in venture funding this year. The firm is called Copia Global. It's an e-commerce company based in Kenya. Now, Copia's goal to bring the power of e-commerce to low and middle income African consumers, with a particular focus in empowering women across the continent. And Tracy Turner, the founder and chairman of Copia Global, joins us now from London to talk about the firm's mission. Tracy, thank you so much for staying up late for us and giving us your Friday evening from London. We really appreciate it. Can you talk to me about what is unique about Copia's business model?
Yeah, sure. Thanks for having me. Delighted to be here. So I think that first, let me just say the African mass market is absolutely enormous. It's about 800 million people, and they spend nearly $2 trillion a year. So it's a huge consumer market that's largely been ignored. And I think the advent of mobile technologies has really changed the ability to reach that market in a profitable way for the first time. So that's the focus of Copia and our e-commerce business there. Using mobile technologies, we've been able to build a model that can serve people even if they live in more rural areas, don't necessarily have internet connectivity, and might not even be banked. So there are some challenges to serving the market, but so you have to sort of take a new lens, not sort of a Western e-commerce approach, but an African-centric approach to e-commerce on the continent.
There's so much I want to talk to you about and dig into, Tracy, because I think what, you just used a lot of terms, not even buzzwords, but terms that I think are important for our audience to understand, especially if they grew up or have been using, Amazon for 20, 25 years. It's a completely different experience in many countries in Africa just because of infrastructure or lack thereof. People's access to internet is primarily through mobile phones in many of the countries, but also that part that you said about people who are unbanked. How do you provide e-commerce to people who don't have bank accounts?
Yeah, good question, right? So one of the things that is ubiquitous across Africa and works really well are there are small mom and pop shops sort of driving the economy in Africa. The GDP of the continent, which is growing incredibly fast, is largely driven by these informal markets. And so what Copia has done is we've partnered with these small mom and pop shops, these SMEs. We have about 43,000 of them who we work with across East Africa now. And they are sort of boots on the ground to help us connect with people who, if they don't have a smartphone and can't order directly with Copia, they can go to their local mom and pop shop, and that small shopkeeper will help them place the order. If they have mobile money and can pay us directly when they place their order, great. But if they don't, they can go to that small mom and pop shop who is a Copia agent and pay through that agent. So the agents sort of are partnered with us to help enable people, even if they don't have smartphones or internet connectivity, or even if they aren't banked, to be able to participate in an e-commerce economy.
I wonder if we can take a tiny detour here because, Tracy, I can't help but think about the number of guests we've had on over the past year who have talked about the underbanked and used that as an example of communities that could really benefit from digital assets, from cryptocurrencies, and said, you know, for the crypto doubters out there, don't worry. There's a real use case here for those who are living in areas where underbanking is a predominant issue. Can you talk about how you rate that argument, and have you seen the success of applying digital assets and digital currencies to areas across the continent of Africa?
Yeah, don't think we need to make the leap all the way to cryptocurrencies here. We're just talking about a largely cash-based society still. I mean, there's a lot of coverage in the news about Africa and the move to lots of fintech tools. But you have to keep in mind that that's still only a very small percentage of the continent. Most day-to-day transactions, buying household goods that drive the economy and drive that GDP growth I mentioned, are still cash-based. So we're just talking about making a move from cash-based transactions to digital transactions. So we don't need to get into the complexity of crypto or anything like that. We're just talking about sort of simple tools that enable them to move to mobile technologies. And you've got a lot of fintechs on the continent now. And so Copia and our e-commerce solution can help drive the move from cash-based transactions to more digital transactions.
Tracy, I want to be really careful in our conversation here and make sure we're not speaking about a continent in a way that doesn't take into account the differences that the more than 50 countries in the continent have. I mean, the experience of somebody in Johannesburg, South Africa, is quite a bit different than somebody who lives, you know, in the hills of Uganda, for example, or in Mali, or in Egypt. So when we do think about the entire continent and the way that your company's business is trying to achieve success there, how do you do that in an area of the world that has such vast differences in wealth and standards of living, in infrastructure?
Yeah, so very good question, and I'm glad that you brought that up. There are 54 countries in Africa, and they're all very different, and they have different governments, they have different regulatory environments, they have different mobile payment systems, they have different levels of internet connectivity, they have different levels of cost of data that all are key components to Copia's success as an e-commerce platform. And we have to take it one country at a time and take into account all of those differences is very, very important. But there are underlying basic tenets that are the same, which is every household has needs. They need to feed their children at night. They need to send them to school during the day with, school shoes and school books. They have many of our customers who are middle income are farmers, so they need to buy inputs to run their small farms. They build their houses one brick at a time, so they're buying construction materials. There's some basic sort of household needs that are similar across the continent. And that informal sector I talked about earlier, the small mom and pop shops that drive the economy, are largely the same across the continent as well. You have more formal markets in some countries like South Africa and less formal markets in places like Uganda, as you mentioned. So that's something that we take into account when we consider how to grow Copia in each of the countries.
That's really, really interesting. I'm so glad you asked that question, Tim. Great question there. I wonder if you can talk about the outreach that you've done to women. Can you talk about how Copia has specifically worked to engage female agents?
Well, I'll tell you the truth, a little secret, which is when I founded Copia, I had no intention of building a business that empowered women. I was purely setting out to build an e-commerce business to serve the mass market in Africa. It's a massive opportunity, huge market, massively underserved, essentially neglected by the global economy. And I thought I can empower these people to be to be global consumers like I am here in London. But what's happened as I built the business was that 81% of those small mom and pop shops we partner with, our Copia agents, are women. 75% of our end customers are women. A huge percentage of our employees are women. Our board is about 40% women. I'm, as the founder, I'm a woman. Like, we've suddenly become this story about gender empowerment. And I think that's because the informal sector in Africa, again, what's driving the GDP of the continent is largely driven by women, and which is not the case globally, but is the case in Africa. And so Copia has ended up just organically been a tool that has empowered women, providing employment, providing access to goods that are more affordable,
Right.
higher quality, et cetera. So it's become something we shout from the rooftops, even though it wasn't originally our intention when we built the company.
Well, thank you so much for joining us this afternoon and I guess this evening for you and sharing part of your story, Tracy. That's Tracy Turner, founder and chair of Copia Global, joining us this afternoon via Zoom from London. Well, let's get a check on the latest world and national news with Nancy Lyons in a 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. The House Select Committee investigating the January 6th attack on the Capitol is reportedly preparing to vote on asking the Justice Department to pursue at least 3 criminal charges against former President Trump. Politico reports, according to those familiar with the matter, the charges would include insurrection, obstruction of an official proceeding, and conspiracy to defraud the U.S. government. The committee will release its report next week. Ukraine has been plunged back into darkness. It's an emergency measure following the latest Russian missile attacks on cities all across the country, described as the worst attack since the invasion began. Ukraine's Deputy Interior Minister Yevhen Yenin says the strikes are designed to demoralize the Ukrainian people.
Attacking our energy infrastructure, making people suffer during the winter time. That's about genocide of our nation.
Yenin says Ukraine's military was able to intercept about 60 of the 76 missiles launched. The U.S. last month pledged $53 million in funding to help Ukraine restore its electrical grid. Today, the State Department said the first shipments have arrived. Angelina Jolie is ending her role as a special United Nations refugee envoy. Bloomberg's Nathan Hager reports from Washington.
The actress and the United Nations issued a joint statement today saying she's moving on to work on a broader set of humanitarian issues and to work more directly with local organizations. The New York Times reports Angelina Jolie has made 60 field visits to global war zones since she began working with the UN in 2001, first as a Goodwill ambassador, then since 2011 as a special envoy of the UN High Commissioner for Refugees. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Palladon. Another losing week for the U.S. stock market, a down Friday as well. Stocks had their longest weekly losing streak since September, with investors concerned that the Federal Reserve's resolve to keep raising rates could tip the economy into a recession. Cleveland Fed president was interviewed just about an hour ago right here on Bloomberg Radio.
The level of inflation is still way too high. 7.1 on the CPI, 6% on the PCE, measured year over year. That's well above our goal. And so that's why we have to continue using our tools to get inflation on that sustainable downward path.
But Marianne Bartels, chief investment strategist at Sanctuary Wealth, who is our guest right here on Bloomberg Business Week, says there are reasons to be upbeat.
One of the things that I learned early in my career is when you're in the bear market, the bull starts running. It starts showing its colors. And you're seeing that in the energy sector. You're seeing that in the industrial sector, the material sector, and parts of the healthcare sector. We have stocks in those sectors that are trading at or near record all-time highs. And we keep talking about a bear market. Well, there are pockets that are not in a bear market.
Today, the S&P down 43 points, down another 1.1%, ending the week, heading into the weekend at 3852. The Dow today down 281, down 0.9%. The NASDAQ Composite Index down 105, lower by 1%. 10-year yield 3.48%, the 2-year 4.17%. Gold up 0.9%, 17.93 the ounce, and West Texas Intermediate crude down 2.2%, 74.44 barrel. Briefly, New York City Uber drivers are planning a 24-hour strike on December 19th, Monday. They're calling for a passenger boycott as well after a judge this week temporarily blocked wage increases. Uber shares today down 1%, rival Lyft down by 2.3%. I'm Charlie Pallet. That is a Bloomberg Business Flash.
Thank you, Charlie. Well, as we wrap up this year, we've got a lot to look forward to, of course, but we've also got a lot of worries from 2022 to carry over. Of course, we're always worried about climate change. We're worried about a potential recession, nuclear warfare. Among this list of concerns, our next guest says that we need to keep our eyes on the upcoming fight for microchips as another thing to worry about. In his new book titled Chip War, Chris Miller argues that microchips are the new oil, and he joins us now to discuss. Chris, thanks for being here, and congrats on the book, named the FT's Business Book of the Year. Talk to me about how the chip war has gotten to this boiling point. How did microchips become the new oil, as you say?
Well, for a long time, most people took chips for granted. We rely on them in all of the devices we use, from smartphones to dishwashers. But because most people never see a chip over the course of their daily lives, we don't really think that much about them. But today, both the U.S. and China are engaged in an escalating chip war for control of the future of computing technology. And the U.S. is trying to use its position to cut off China's access to the most advanced chips and the most advanced tools used to make chips. And right now, China's still quite far behind. So it's very dependent on accessing U.S. technology. And if it can't get it, then China can't produce the most advanced semiconductors.
Is there, Chris, just like one instance you can point to in the history of how this has evolved, how this has developed, that said, okay, that is where the U.S. and that is where Europe misstepped, rather. That is where we got it wrong. That is the moment we lost this.
One of the biggest shifts over the past decade has been the growing importance of the Taiwan Semiconductor Manufacturing Company, which is the world's biggest chip maker and today produces 90% of the world's most advanced processor chips
TSMC.
In Taiwan. TSMC, that's right. And for a long time, other countries were very happy to buy TSMC's products produced in Taiwan because they're extraordinarily advanced and cost efficient. But we've gotten to a point where today the world is fundamentally dependent on chips made on one very small island, which also happens to be the world's most dangerous geopolitical hotspot.
To what extent has TSMC's location and dominance in this helped Taiwan as a region avoid danger?
Well, I'm not sure that it has. You can certainly find Taiwanese leaders like President Tsai Ing-wen suggest that Taiwan's criticality in the chip industry provides what she calls a silicon shield that guarantees against the Chinese attack. But the reality is that China's government has wanted to control Taiwan since before the first semiconductors were invented. And in many scenarios, I think what you'd find is if China were to escalate militarily, the U.S. might even be deterred from coming to Taiwan's aid because it was afraid of disrupting chip supply chain. So I think there's a lot of reason to be skepticism that this silicon shield thesis actually works out.
I've spoken to some folks who work in the industry, and they say that even if we are able to figure out a way to build chips in locations other than China, that it doesn't really matter because the components that go into so many of these products end up going through China or being from China. Essentially, we're inextricably bound from a supply chain perspective. Is that the case?
Depends on what type of goods you're looking at. But if you take a smartphone, for example, Apple procures all of its key chips from TSMC in Taiwan. And it's true that most of Apple's iPhones are assembled in China, but the assembly part is the lowest value add part. It's the easiest part to move. And in fact, Apple's already committed to moving a substantial share of its iPhone assembly outside of China over the next couple of years, where right now there's absolutely no pathway for Apple or any of the world's other key electronics company to find other suppliers for the most advanced chips. So the reality is that China does things in the electronics space that are movable, and Apple's doing it right now. TSMC does things that no one else can replicate.
Is the assembly easy to kind of move, though? I wonder how true that is in practice, given the labor practices that go on in China that we just could never replicate here in the States.
Well, I think it would be hard to move to the United States, but that's not where it's going to move to. It's moving to Vietnam, where Samsung already has really substantial assembly facilities. It's moving to India, where Apple is already assembling some of its devices. And in places like Vietnam and India, labor costs are actually lower than in many parts of China. And so I think these are countries where it is actually quite competitive to assemble electronics.
Well, I want to ask you about a move from the Biden administration this week, blacklisting dozens of Chinese tech firms, with signs emerging that Japan and the Netherlands, they're going to align with U.S. restrictions on selling crucial chip-making equipment to China. That's a big blow to Beijing, I imagine. How do you rate that move from the Biden administration?
Well, I think the Biden administration realizes correctly that the future of military power will be defined by access to the most advanced chips. And if you think of what it takes to train and to equip a drone to fly semi-autonomously through contested battle stations, for example, you need a lot of advanced sensors, a lot of processing power, a lot of memory, and all that requires semiconductors. And so there's no doubt, whether you talk to defense planners in Washington or in Beijing, that they're envisioning military systems that will be critically reliant on access to the most advanced chips, which is why the Biden administration is trying to prevent China from accessing these semiconductors.
It makes a lot of sense, Chris. I wonder if we can kind of end where I started with you. This is another issue to add to the list of things that keep me up at night. I'm curious, if you're at a dinner party and talking to folks about why they should read your book and add to their list of worries heading into 2023, what do you tell them about why it's so important to understand the risks involved with the chip war?
Well, just in the past 2 years, the chip shortages that emerged out of the pandemic caused hundreds of billions of dollars to global manufacturing output and delays to automobiles and other goods that couldn't be produced because you didn't have enough chips to make them. And that was in a time when chip production actually rose globally in 2020 and 2021. It just wasn't fast enough to meet our demand. Imagine if Taiwan, which produces over a third of the world's new computing power each year, were to stop supplying chips. It would be the worst manufacturing collapse since 1929 in the Great Depression.
Wow. Okay. Well, that's something to leave us on. It's just incredible what that island does when it comes to this processing power. Chris Miller, Associate Professor of International History at Tufts University. He's the author of the new book, Chip War, The Fight for the World's Most Critical Technology. He's also part of Green Mantle. He's the director of Eurasia over there as well. Chris, thanks so much for joining us this afternoon. Really appreciate you taking the time. You're listening and watching Bloomberg Business Week on Bloomberg Radio, on YouTube, and on Quick Take.
It is 4:53 on Wall Street. Charlie Pellet with some of today's company headlines. Big news in New York. Goldman Sachs may eliminate as many as 4,000 employees. As CEO David Solomon battles to contain a slump in profit and revenue. Today, Goldman Sachs shares down by 1%. Sources say top managers have been asked to identify potential cost reductions, and no final job cut number has been determined. Headcount of the Wall Street giant has surged in recent years as Solomon completed acquisitions to build a more diversified company. Again, Goldman Sachs shares down today by just about 1%. Sources tell Bloomberg Boeing is closing in on an order for as many as 200 of its 737 MAX jets from Air India's new owner Tata Group as the two sides race to wrap up talks before the year-end holidays. On a down day for the rest of the market, we have Boeing shares advanced today by about 0.5%. Asset management giant BlackRock is cutting costs across 8 of its exchange-traded funds as the industry's endless fee war continues. The world's largest ETF issuer is lowering the expense ratios of 3 corporate bond funds and 5 factor following equity products. Adobe shares did advance today after earnings, picking up 3% today. The software company reported adjusted earnings per share that did beat expectations again on a down day for tech stocks. stocks, we saw Adobe rally by 3%. A down day on Wall Street, and those are some of our company stories we're following. I'm Charlie Pellett.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Madison Mills in for Carol Masser on this Friday afternoon. Let's get to Washington, D.C. now for an update on world and national news. For that, we turn to Nancy Lyons in our 99.1 newsroom. Hey, Nance.
Thanks, Tim. Ukraine is calling today's Russian missile attacks the worst since the invasion began. Russia launched over 60 missiles, causing cuts to power and water supplies in several areas. The attacks come a day after a top Ukrainian army commander warned there's no doubt Russian forces will attempt to seize Kyiv as soon as January. Well, the U.S. is doing what it can to rush weapons to Ukraine. We get more on that from Bloomberg Government's Emily Wilkins.
The Pentagon is finding ways to sort of do some shortcuts to standard contracting procedures just to make sure that the U.S. weapon supply still remains strong, even as they continue to supply Ukraine with the more weapons they need.
Bloomberg Government's Emily Wilkins in Washington. President Biden is spreading the word to U.S. military veterans about his administration's efforts to improve their medical care. Bloomberg's Irv Chapman has more on Biden's trip today to Newcastle, Delaware.
The president urged them to seek the care and benefits Congress recently authorized for those exposed to the huge pits where toxic materials were burned during the Iraq and Afghanistan wars.
It's one of the most significant laws in our history to help millions of veterans who are exposed to toxic substances during the military service. I'm urging all veterans of these decades of war to get screened for toxic exposure and to promptly file your claim.
The president lauded those who were deployed again and again in the recent wars, as well as a 102-year-old Air Force veteran of World War II who came to hear him. In Washington, Irv Chapman, Bloomberg Radio.
The House committee investigating last year's attack on the Capitol will reportedly vote in favor of recommending criminal charges against former President Trump. Politico reports the charges include insurrection, obstruction of an official proceeding, and conspiracy to defraud the U.S. government. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to you, Madison and Tim.
Thank you so much, Nancy Lyons, for that update. Really do appreciate it. A story that broke in the last hour from Semaphore that is getting our attention is about another Elon Musk story,
Of
Madison.
course.
He's now seeking new investors for Twitter at $54.20 a share. That's the same price he paid when he took the company private for $44 billion in October. That's according to the news site Semaphore.
Yep, and of course this comes after a stressful week at Twitter, banning several journalists who cover Elon Musk, banning the teenager who covers the Elon Jet account, tracking where his jet goes. But it's been a tough week for Musk. It's also been a tough week for Tesla.
Been a tough week for Tesla. It's been a tough couple of months for Tesla. I want to draw everybody's attention to a handful of tweets from Ross Gerber that Elon Musk has responded to. Ross Gerber, of course, you know him from our airwaves. He's the co-founder, CEO, and CIO at the investment advisor Gerber Kawasaki. He's also got a new ETF. For the entire time that I've known him and interviewed him, Madison, he's been such a Tesla bull. Talking about, he comes on and talks when it's Tesla earnings, and he loves the company. But for the last few days, he's been tweeting about how the board of directors essentially has been MIA. He tweeted this afternoon, Elon has now erased $600 billion of Tesla wealth and still nothing from the Tesla board of directors. It's wholly unacceptable. Elon Musk actually replied to this, saying that Tesla is executing better than ever. We don't control the Federal Reserve. That, Elon Musk says, is the real problem here. To that, I would say, Madison, every company experiences the same macroeconomic conditions, depending on where they sell. There are a lot of companies that experience, the Federal Reserve and higher interest rates.
Every single one.
Exactly.
Right? And yet we're still seeing Meta doing well today. We're still seeing